At the very heart of finance, there's this one single trillion-dollar question. How much is a company's future actually worth? Today, we're going to dive deep into how people try to answer that, specifically by calculating the return investors demand for owning a stock. You'll see why it's been one of the biggest debates on Wall Street for decades.
So let me ask you this. If you could only know one number, just one, to make every single financial decision, what would it be? It sounds simple, right? But it's a question that has kept the greatest minds in finance up at night for, well, generations.
And here's the wild part. This one number steers trillions of dollars in capital. It decides whether a company builds a new factory or how your retirement fund is invested. And yet, for all its importance, almost nobody agrees on how to actually calculate it. It's a total paradox.
That number is called the cost of equity. The easiest way to think about it is like a hurdle rate for a company. If a new project can't generate a return that clears this hurdle, then it's not really creating any value for its owners. The problem is, no one can agree on just how high that hurdle should be.
Now, for the longest time, the go-to methods were these things called factor models. But even the guys who invented them famously admitted they were, and I'm quoting here, distressingly imprecise. I mean, come on, not exactly a vote of confidence when you've got trillions of dollars on the line, right? So yeah, the stage was set for some new contenders.
And that brings us to our main event tonight. We've got two rival models squaring off, each one fighting to become the new champion of valuation. We're going to put them through their paces, head-to-head, to see which one, if any, can finally answer that trillion-dollar question.
All right, in this corner, we have the reigning champ, ICE, which stands for Implied Cost of Equity. Think of this as the accountant's view. It looks at a stock's price and what Wall Street analysts predict for future earnings, and then it works backward to figure out the return investors must be expecting. And in the other corner, we have the challenger, QCE. This is the investor's view. It doesn't care about forecasts. Instead, it looks at what companies are actually doing, how much they invest, how profitable they are, to build its estimate. So, two totally different philosophies.
Okay, let's get to round one, picking winners. This is a really simple but super powerful test. We just use each model to rank all the stocks from highest expected return to lowest. The question is, which model is actually any good at finding the stocks that go on to become the top performers? Let's see what happened.
Wow. Okay, the results here are, well, they're pretty shocking. The top stocks picked by the QCE model, the investor's view, delivered a fantastic 1.62% average return per month. Now look at the stocks picked by the IC model. They actually lost money. A negative return. That is a straight-up knockout in the very first round.
So yeah, round one is a huge, decisive win for QCE. It really does seem to identify stocks that go on to deliver higher returns. That is a massive blow landed by the challenger.
All right, on to round two, hitting the target. This is all about accuracy. You see, a good model should be like a good weather forecast. If it says there's a 90% chance of rain, you'd expect it to rain about 9 times out of 10. In finance, we call this a predictive slope, and a perfect, unbiased forecast gets a score of exactly 1. Let's see how our contenders did.
And again, the difference is just night and day. QCE gets incredibly close to that perfect score of 1, clocking in at 0.82. But the IC model? It's way off, down at 0.42. What that means is its forecasts aren't just a little off, they're consistently and significantly biased. It's like that weather forecaster who is always promising sunshine.
So that's another round in the bag for QCE. At this point, the evidence seems pretty overwhelming, right? Based on the two most direct tests we can run, the investor's view, QC, is the clear champion. But hold on, the story isn't quite over yet.
Just when we were about to raise the challenger's arm in victory, the data throws us a massive curveball. It turns out there's a twist. And the winner? Well, the winner actually depends entirely on the question you're asking.
So here's the split decision. If your question is, which specific stock is going to outperform another one, then yeah, QCE is your hands-down winner. But if you change the question to, what is the direction of the entire market likely to be, well, that's when IC, the old champ, makes a stunning comeback.
And we're not talking about a small comeback. ICE is shockingly good at predicting the market's overall direction. Its R-squared, which is just a fancy term for its predictive power, gets as high as 24.5%. Now, to put that in perspective for you, in the world of market forecasting, anything over just 5% is considered really, really impressive. So this is huge.
So, what on earth is going on?
How can one model be amazing at picking individual stocks, but terrible at predicting the market, and the other one be the exact opposite? Well, this split decision isn't a flaw in the research. It's actually a profound clue about how the market really works.
The answer is baked right into their DNA. See, these models aren't just different sets of formulas. They represent two completely different philosophies, two fundamentally different ways of seeing the financial world.
Let's break it down. ICE, the accountant, implicitly sees the market as a big, predictable, cyclical machine, and its strength is forecasting the overall rhythm of that machine over time. QCE, the investor, sees the market completely differently. It sees it as a complex, evolving system where what matters most are the actions of the individual companies inside it. So its strength is in comparing those firms at a single snapshot in time.
And this gets at a really brilliant point that the researchers themselves make. The economy isn't just one or the other. It kind of has these predictable rhythms, yes, but it is also a dynamic, always evolving network of individual players. It's both.
And that leads us to the big takeaway here. There's no single best model. There's no magical one-size-fits-all answer. The best tool you can use, the right way to figure out what the future is worth, depends entirely on the specific question you're trying to answer.
So what does this actually mean for real-world decisions? Well, think about it. If you're a CEO deciding which new project to invest in, you need to compare individual opportunities. You should probably use a model like QCE. But if you're an investor trying to figure out if it's a good time to be in the stock market at all, you'd want to look at the big picture signals coming from a model like ICES.
So I'll leave you with this final thought to chew on. When you think about the future, what are you trying to predict? Are you trying to predict the overall rhythm of the machine, or are you trying to predict the actions of the individual players inside it? As we've seen today, the truth might be that you really need to understand both.